各位嘉宾午安，感谢您参与今天的线上研讨会。我是 T-Consult 台湾代表 Amanda Shi， 今天由英国顾问公司 T-Consult 创办人 Mr. Ross McGill 担任主讲人。Mr. McGill 是一位在全世界享誉盛名的美国税务顾问专家。他的公司 T-Consult 协助许多非合规的中介机构，也就是所谓的 NQI， 成为合规中介机构，也就是所谓的 QI， 并且有效管理符合美国税法的遵法合规计划。现今，大部分的台湾金融机构为 NQI， 但许多金融机构正在思考成为 QI。他们对法规了解不足，或是知识不够，所以难以做出最佳的决定。那今天 Mr. McGill 在这里协助说明 NQI 面临的挑战，以及成为 NQI 的好处。现在让我们欢迎 Mr. McGill. Now, welcome Mr. McGill.
Good afternoon, everyone. It's a pleasure to be here and to be presenting this webinar to our colleagues and friends in Taiwan and Singapore and Hong Kong. First of all, I would like to say stay safe. These are difficult times for us all, and I'm sure that many of you are enjoying working from home as we have been doing for many years. The subject today is the challenges for non-qualified intermediaries and the benefits of being a qualified intermediary. But first, before we get into that, I just want to make sure that you're aware of who we are and what we do. So you've already heard from Amanda. Amanda is based in Taiwan. We also have on the webinar today Marco Zawar, who is based in Hong Kong, and they are two members of our team. I am the founder of the company, and I founded the business in 2003. And when I joined the business or the industry, there were very few books about withholding tax and no books at all about US withholding tax. And so I had to learn from the start. And in the end, I decided that the best thing to do for everyone else was to write the book on the subject. And now I have written 10 books on withholding tax and international regulations. So I hope that if anyone is interested in reading more about this subject, please feel free to go to typical sites like Amazon.com or our publisher's website at Palgrave Macmillan. We have clients today in 15 countries around the world, and that gives us a unique insight into the kinds of problems and the kinds of challenges that non-qualified intermediaries have. However, that has not stopped us from being able to prepare and offer a wide range of services to our clients. And those services fall into three broad categories. We provide training and education for financial institutions so that they can understand the regulations and be able to make informed decisions, for example, about whether to become a qualified intermediary or not. We also provide consulting services, which allow us to work with you on an ongoing basis to understand and apply the regulations in your specific circumstances. In addition, there are some parts of the regulation which require you to process data. That might be validating tax forms, or it might be filing reports to the IRS. And so we have a range of data processing solutions and offerings which will help you overall to be compliant with US tax regulations. All of that is delivered by our people. And the team that I have with me, I'm very proud of. Kirsty, who's the CEO of the business. Stuart is UK subject matter expert. And we have a range of subject matter experts who are located around the world, including Amanda and Marco, who are well able to understand and help our clients wherever they are. But let's talk about the subject and why you are on this webinar today. Non-qualified intermediaries are in Chapter 3 and Chapter 4 of US tax regulations have certain challenges. The first is reputational exposure. And I'm going to talk about these just at the top level on this slide, and we'll go into more detail in the rest of the webinar. But typically we are talking about a financial institution that's located outside the United States that receives US sourced income. And that means that those financial institutions are subject to US tax regulations. You become subject to those regulations simply by the fact of receiving the income from the United States. So there is no circumstance in which you are not subject to these regulations if you're receiving income on behalf of your clients. And there is a reputational exposure here. It's reputational because non-qualified intermediaries are deemed by the United States government to be facilitating tax evasion. In other words, the US thinks that non-qualified intermediaries are the bad guys and that qualified intermediaries are the good guys. And that is a reputation issue for you as well as an operations issue. There is a language and comprehension challenge, particularly in Asia. I've been traveling around Asia and the rest of the world now for over 17 years. And I have noticed very clearly that once you move away from the United States and travel eastwards, the level of knowledge and the level of understanding about these regulations tends to drop. Of course, as you move away from the United States, the other thing that changes is that other languages become more frequently spoken. All of these regulations in Chapter 3 and Chapter 4 are not even written in English. They are written in a language called Tax Technical American. And that language has two dialects. The first dialect is about Chapter 3, and the second dialect is about Chapter 4, and they sound very different. And so it's important for anyone, particularly in Asia, who wants to try and understand what the challenges are, is to understand, first of all, that the basic language that is being spoken here is a complicated version of English. And that's a challenge for many non-qualified intermediaries and also for QIs. There are also operational challenges for NQIs, and those really focus on the singular elements in the process of receiving income and paying that income to your clients. That would mean documenting your clients using US tax rules. And I'll talk a little bit about the W-8 forms, which are forms which many of you will know and love for many years. Documentation, how withholding occurs. So is it you that's withholding the tax or is it someone else? Depositing the tax with US Treasury and then reporting what's been done. All of those elements apply to both non-qualified intermediaries and qualified intermediaries. The challenge is that because non-qualified intermediaries are deemed to be facilitating tax evasion, the rules for non-qualified intermediaries are much more strict and much more difficult to comply with. The rules for QIs are much easier to comply with because the IRS trusts you. So we'll talk a little bit about that later on as well. There is also a financial risk exposure from being a non-qualified intermediary. And again, this has to do with the fact that NQIs are deemed to be facilitating tax evasion. The documentation and the reporting has to be done at beneficial owner level. So for example, if you are in Taiwan and you have 1,000 clients and they're all Taiwanese residents and they receive US sourced dividends, then you must report those to the IRS, each one individually. And you must also send a copy of the report that you sent to the IRS to your customer. And that means that the reports are much higher in volume than a qualified intermediary, because a qualified intermediary can pool all of those customers just by the tax rate that was applied to their income. Now, why does that give you a financial risk exposure? Well, the financial risk exposure exists because there are a number of points at which the IRS expects financial institutions to do certain things. The most important is reporting on time. And late filing penalties are the largest penalties that the IRS imposes on non-US financial institutions. And they are calculated per form. And so if you are a non-qualified intermediary, you will have lots of forms. If you're a qualified intermediary, you'll have very few forms. The net result is that you are facing a much larger penalty if you are a non-qualified intermediary, and you can reduce that quite substantially by converting to being a QI. But again, I'll talk about that in a little while. There's also a compliance exposure to the IRS and domestic competent authorities. Why is that? Well, everyone is subject to Chapter 4. So when I talk about the IRS Chapter 3 and Chapter 4 regulations, many of you will know that Chapter 4 is another word for FATCA. And Chapter 3 is another word for the QI and NQI regulations. Chapter 4 is all about anti-tax evasion, and everyone has to meet a FATCA obligation. Chapter 3 is all about the taxation of US sourced income, and that is separate to Chapter 4. Now, the compliance exposure for non-qualified intermediaries and qualified intermediaries lies in FATCA, and that will depend on whether the jurisdiction in which you are resident has an intergovernmental agreement with the United States. If it does, those IGAs basically say that if a financial institution gets something wrong, it's not the US government who is going to be coming after you, it's your domestic regulator. And so the IGAs fundamentally move the obligation for controlling and regulating financial institutions over to your domestic regulator. And you will normally have other obligations to your domestic regulators, but you don't want the American government to be coming to your domestic regulator to say, you need to take care because this financial institution isn't doing a good job. So what I want to do now is go into some of the details of those areas of challenge that I've just spoken about. But the first question, of course, is, well, what's an NQI? And I often have to start most of the training courses that we run by asking people to tell me what level of knowledge they have. And that allows me to explain in more easy detail and an appropriate level for the audience. Of course, I don't have that facility today in this webinar. So please forgive me if you already know some of the basic things that I'm going to tell you, but there are people who are on this call who may not know, and for them it will be useful. So what is a non-qualified intermediary? Well, first of all, NQI is a term that's only used in Chapter 3 of the US Internal Revenue Code. it describes a non-US financial institution. In other words, you can be located anywhere except the United States. A non-qualified intermediary receives US-sourced FDAP income. FDAP stands for fixed, determinable, annual, or periodic. For most firms in Asia, 95% of what you receive from the US is likely to be dividends from US corporations or portfolio interest on bonds. So you can be located anywhere except the United States, and you must be receiving US-sourced income. You will not have signed a QI agreement. Now, all of those together mean that in the world today, there are around about 5,000 to 6,000 QIs. That means that almost all financial institutions are actually non-qualified intermediaries. But the IRS is very keen to get more financial institutions into the QI program. And most qualified intermediaries are in Europe. The number of QIs in Asia is small, but it is growing very rapidly. And I hope that the content of this webinar will help to explain why. The first point is that reputational issue that I spoke about earlier. And that is that in 2009, then President Barack Obama stood outside the White House and made a speech. And in that speech, he specifically mentioned non-qualified intermediaries and that the position of the US government, which has not changed since, is that any financial firm outside the United States that does not sign a QI agreement will be deemed to be facilitating tax evasion. That speech was a very powerful speech, and it had a massive impact on the way that the industry operates. Some of you may have received information or communications from financial counterparties in which you are being told, we can only do business with you if you are a QI. That approach is a commercial approach, but it was driven by Barack Obama's statement in 2009. No one wants to do business with a financial institution that the Americans think might be evading tax. So that was the background, but what I mentioned about reporting and operational challenges is also important. A non-qualified intermediary must report every single customer separately that receives US-sourced income. You must also remember that many of these people, if not all of those people, will not be Americans. FATCA is about trying to find Americans, and it's very common for financial institutions in Asia not to allow Americans to have accounts. So that's one side of the coin. The other side of the coin is that anyone who is not an American, but who receives their US income through a non-qualified intermediary will have their information reported individually to the United States government every year. And that can create problems of its own, the biggest one being data privacy. But we'll talk about that a little later on as well. There are two types of non-qualified intermediary: disclosing and non-disclosing. Now, if you read the regulations, the IRS has an assumption in the regulations that all non-qualified intermediaries will disclose who their customers are to another financial counterparty, usually a qualified intermediary or a US withholding agent. Now, that's the presumption in the regulations, but the regulations also provide for what happens if an NQI does not disclose. And the answer to that is that a 30% tax must be applied because of the non-disclosure. Now, of course, there are several reactions that the financial industry has taken to this. Even though the Americans have said, we expect you to disclose your customers to another financial institution, many financial institutions that are non-qualified intermediaries choose not to disclose. First of all, they don't really think that 30% is a very heavy penalty to pay for not disclosing their clients. And secondly, they do not want to give the identities of all of their customers to what might be a competitor. And so across the world, and in particular in Asia, we find that non-qualified intermediaries often choose not to disclose who their clients are to anyone else. And as a result of that, they take on the obligation of filing reports every year to the IRS at individual beneficial owner level. And so there are challenges around whether, as a non-qualified intermediary, you are choosing to disclose your customers or not disclose. And we'll talk about that later on as well. So, the obligations of non-qualified intermediaries fall into four broad areas. And these areas are all specified in US tax regulations. One of the most common things that I am faced with is a non-qualified intermediary who says, I'm not subject to US tax regulations because I haven't signed a QI agreement. So let me put that myth away. That is not true. You become subject to US tax regulations as soon as you receive US sourced income on behalf of your clients. That means that you are an intermediary and the American tax rules apply to you. That's called extraterritoriality, and many people don't like it, but unfortunately, it's the world that we live in today. So there are four areas that a non-qualified intermediary must look at. The first is the obligation to document your customers, to know what their Chapter 3 status is, and to know what their Chapter 4 status is. The second is, if they receive US sourced income, is to ensure that US tax is properly withheld. And there are a number of different ways in which that withholding can be arranged. It's usually discussed between a non-qualified intermediary as a financial institution and the institution immediately up the chain from them that will be paying them that US sourced income. And that conversation determines often how that withholding happens. It's written down on a form called a W-8 IMY. IMY stands for intermediary. So if you don't think you've had that conversation with your counterparty, the fact is you probably have. You told them what you were going to do and how you were going to do it as soon as you presented them with that W-8 IMY. That form also will have told the counterparty how the deposit of tax is going to be accomplished. But ultimately, the obligation and the liability for making sure that the tax arrives with the US Treasury remains with you. Finally, once you have documented clients, withheld tax, arranged for it to be deposited with the US Treasury, that happens all the year round. When you get to the end of each year and into the beginning of the following year, you have an obligation to report to the IRS what you did in the previous calendar year. So first of all, the US tax year is a calendar year, January the 1st to December the 31st. The normal reports that you will be sending are information returns, which are forms 1042S, and for a US tax return, which would be a form 1042. Now, I don't like to make things complicated, but if you are a disclosing NQI, all of that reporting will probably be done by your counterparty, to whom you disclosed all of your clients' information. If you did not disclose, like most financial institutions do not, then that obligation to report rests with you. So those are the 4 areas that NQIs have to achieve under US tax regulations. Well, what problems does that give you? It gives you quite a few, and here are just some of them. The first one is non-qualified intermediaries are not popular. They're not popular because they're difficult to deal with, especially if they want to disclose their clients. Consider that if I'm a financial institution, let's say in Taiwan or Singapore or Hong Kong, and I have a client that is a non-qualified intermediary, I have an obligation to document my own clients under US tax regulations. But if I have a non-qualified intermediary who has 10,000 customers and they tell me that they want to disclose their clients to me, I'm now going to receive 10,000 W-8 forms, and I'm going to have to check that they're correct. And so apart from the fact that the US deems you to be facilitating tax evasion, it's going to be very difficult for a counterparty to start receiving an unknown number of forms and other data. And so generally, first of all, NQIs are unpopular. And secondly, counterparties may not even do business with you because they may not want to receive that kind of documentation. If they do, then they may charge you, especially if you're going to disclose. They also may say, we will only do business with you if you do not disclose, because then their life becomes easier and you have to deal with the consequences in reporting and documentation yourself. The third element is that you may, without knowing it, be breaking your own local data protection laws. Now, if you remember, in FATCA, there are intergovernmental agreements. The reason that intergovernmental agreements exist is because many countries complained to the United States that they couldn't send a FATCA report from a financial institution directly to the US government because that would break data protection rules in their domestic jurisdiction. The solution to that was the intergovernmental agreement, and that meant that a financial institution sends the information to their domestic tax authority, so they're not moving the data outside of their country, so they're not breaking data protection laws, and then it's the domestic authority who sends that data to the United States. So that was the way that Chapter 4 handled the data protection issue. But the same does not apply in Chapter 3. And in Chapter 3, since 2001, financial institutions have had to file 1042-S reports to the US government. Now, the difference here is that in FATCA, you would typically be reporting an American account holder. But as a non-qualified intermediary, in Chapter 3, you will be sending a 1042-S report for every single customer that is not an American. So in Taiwan, in Singapore, in Hong Kong, you will be reporting each individual customer with their name, their tax ID, their address, the total amount they got paid during the previous year, and the amount of tax that was withheld, as well as the name and address of any other financial institution that was involved in that transaction. And that information moves every year, and it goes directly to the United States. And so non-qualified intermediaries may have a data protection problem, and qualified intermediaries do not. And the reason is that a qualified intermediary gets a benefit, in as much as when it reports to the IRS, it's allowed to pool or aggregate all of its customers just based on the on the tax rate that was applied to them during that year. So if someone had 1,000 clients and every one of those clients was taxed at 30%, then that's one report. A non-qualified intermediary would have had to have sent 1,000 reports. So QIs do not have to disclose who their customers are to anyone, whereas NQIs do. The other benefit, or sorry, the other challenge for an NQI is if you're an NQI and you're resident in a country that has a tax treaty with the United States, it's probable that lots of your customers would be entitled to the benefit of that tax treaty. The problem is that non-qualified intermediaries are not allowed to grant tax treaty benefits on their own. That's one of the challenges. The only kind of financial institution that can grant a treaty benefit is a qualified intermediary. And so the only way in which a non-qualified intermediary can offer a benefit to its customers of a double tax treaty reduction is by disclosing all of its customers to a qualified intermediary. And we've already said that has a difficulty because you may be giving information about your customers to a competitor. The only other way that you can grant treaty benefits, of course, is by becoming a QI. Now, I mentioned earlier that you will have reporting at beneficial owner level, and that has an operational challenge for NQIs because generally speaking, you will have many more reports to create. Now, the report that you send to the IRS is just one data file, but it could have many thousands of lines of data in that file. Equally, a non-qualified intermediary is required under the regulations to provide a copy to the recipient. And so non-qualified intermediaries can be faced with very large amounts of work, first of all, to create the data file, and secondly, to create a copy and then mail that copy or email it to every single one of their clients. That takes a lot of time and a lot of effort. And if you get it wrong, the penalties will be higher too, because the penalties for late filing are based on how many forms there were, and NQIs will have many more forms than QIs. So all in all, there are many challenges for non-qualified intermediaries. Let's think about one or two more. Typically, and I mentioned this in the last slide, a financial institution that is a counterparty to you and upstream in the chain of payment may not want to receive your documentation about your clients. They don't know how much there is, they don't know how accurate it is, and they will have to implement resources to be able to validate those forms. I have to tell you that in the 17 years, probably more, that I have been working in this area, in Asia, the failure rate of W8 forms, and most financial institutions will use the form W8, typically a W8 BEN or a BEN-E or an IMY. Over 70% of those forms that I see are not fit for purpose because they have been incorrectly completed by the beneficial owner, and they have not been picked up or cross-checked by the financial institution that received them. And so 70% of what the industry is using as the basis of withholding the right amount of tax are not fit for purpose. That number does vary. I have seen Asian financial institutions anywhere up to 90% failure rates, and I've seen institutions in Europe with failure rates down as low as 30%. I can validate a W8 in less than 30 seconds. And the reason that I can do that is because I know the kinds of mistake that beneficial owners make, and I know the kinds of things that financial institutions do, or rather don't do, that they should be doing. Now, we're talking about NQIs, and one of the fundamentals about being an NQI or a QI is that you are receiving US sourced income and you are withholding or arranging for the withholding of tax. Now, in order to achieve that, the IRS has created an idea called a withholding statement. So if a non-qualified intermediary chooses to disclose to its counterparty, it will do two things. It will send all of the W-8s that it received from its customers to its counterparty. But that's not enough. It also needs to send a withholding statement. And a withholding statement can easily be a spreadsheet, but it lists each beneficial owner and it tells the counterparty what proportion of any payment is allocated to each beneficial owner for which there is a W-8. So these two ideas go together very closely. And very often, I find that withholding statements are either inaccurate because the documentation is not correct, or actually that they are just completely absent. And that causes two problems. First of all, non-qualified intermediaries are expected to know and understand about withholding statements. But so are QIs. And very often we find even that qualified intermediaries will either not receive a withholding statement and just make an assumption that they're not entitled to give, or they will not apply a withholding statement correctly. And so there are many problems associated with non-qualified intermediaries disclosing, which is why we still see many, many NQIs that don't disclose. But you should not assume that just because you're not disclosing, that you don't have to send a withholding statement. That's not true either. Remember, we're talking about Chapter 3 and Chapter 4. And so there is a rule in the US regulations that says if you are a non-qualified intermediary and you do not disclose, clearly you can't send a withholding statement that identifies each client, but you do have to send a withholding statement that confirms that you have no FATCA withholding that needs to apply from Chapter 4. So withholding statements are important in all circumstances. The biggest issue that I find, however, is that non-qualified intermediaries very often, whether that's through language, whether it's through culture, or whether it's just not being aware, is that they don't understand these regulations. Now, the regulations when they came out in 2001 were 800 pages long. Since then, the IRS has issued many notices, many announcements, many revenue procedures, lots of different ways that they tell you what the changes are to the regulations. And so now the regulations that you need to meet if you receive US sourced income on behalf of a client are easily 2,000 pages long. And that's hard work when it's not written in your language and it's written in tax technical American. So that is really where all of the challenges start, is understanding. And I said before, I often find that non-qualified intermediaries, because they have misunderstood the regulations, they think that they don't apply to them if they get taxed at 30%. Yes, so it's either we didn't sign a QI agreement, so we're not subject to the regulations, or, well, you've taken as much tax as you can possibly take, therefore we don't need to do anything else. That's not true. And so when I talked about challenges, the first point here is that NQIs are a higher risk. They're a higher risk in a number of different ways. NQIs are substantially more exposed to penalties in Chapter 3 because they are more likely to have got the documentation wrong. Remember, that's 70% failure rate, which means that in many cases, they may have got the withholding wrong. And let me say here that even if you are taxed at 30%, you can still get the withholding wrong because the 30% tax rate has to be categorized. And the tax categorization can either be, this is 30% as a FATCA penalty, or this is 30% as a tax on US income. And that's called NRA withholding, non-resident alien withholding. And so you need to remember that just because you are being taxed at 30%, perhaps because you did not disclose your customers, or even because there is no tax treaty, such as Taiwan, where there's no tax treaty with the United States, you're going to be taxed at 30%. But you still have to get the categorization of that tax correct. So the lack of understanding of the obligations, the fact that those obligations are written in a different language quite often, and a much more technical language, very often mean that non-qualified intermediaries are far more likely to report late or not at all. And the penalties are applied for each form that is due to be submitted. Equally, if you don't provide the IRS with their file on time, it's almost guaranteed that you will also fail to provide your recipients with copies too. And you have to provide those recipients with copies within 30 days. We'll talk about the penalties there in a little while. So the reason that NQIs are at higher financial risk, certainly, is simply because the US does not really trust NQIs, and the rules have been set so that much more information flows from non-qualified intermediaries, and failure to provide that information is penalized for each line of data that is late. So I've talked a lot about FATCA and NRA, or the taxation of US sourced income. Let me just, at this point, give you, or try and give you, a clear explanation of the difference between the two. So on this slide, you can see the large blue circle, which represents all of your customers. Now, as a financial institution outside the United States, you will be subject to Chapter 4 of the US Internal Revenue Code, and the purpose of Chapter 4 is to prevent tax evasion by Americans. And many of you will know the history of FATCA, and essentially this means that even though you don't have any Americans as customers, you are required to conduct due diligence tests and have the Chapter 4 status of every single one of your customers, whether or not they receive US sourced income. And that is basically because the Americans want to make sure that you clearly know who your customer is and whether they are an American or not. So Chapter 4 is about anti-tax evasion, and you are required to know all of your customers' identities and statuses. Now, you'll notice that in all of that description, I did not use the phrase NQI, and that's because FATCA has a different dialect in the US tax language. So in the US tax language, in FATCA, a financial institution in Taiwan or Singapore or Hong Kong would be a foreign financial institution, or an FFI. It's only when we come to look at the receipt and taxation of US sourced income that we come across the idea of an NQI. So Chapter 3 of the US Tax Code, which is often called the Non-Resident Alien Code, is all about the taxation of income. It's not really about anti-tax evasion. It's about the taxation of income paid by US sources to customers outside the United States. Now, the problem is that there is a little bit of overlap. And so if you are going to find someone who has not provided you with the right information under FATCA in Chapter 4, if they also happen to receive US sourced income, then you'll be required to apply a penalty. So obviously, the only time you can apply a FATCA penalty is if there is income from the US on which to apply the penalty. And so we have a subset of all customers, which is those customers that receive US income. And they have two elements they need to be concerned with. The first is any income that's paid to a non-US person and what the tax rate is, but also whether there is any FATCA penalty that needed to have been applied before that. So that describes how FATCA and Chapter 3, or Chapter 4 and Chapter 3, overlap within one set of clients. So let's talk a little bit now about the operating model challenges, because our consulting practice, and I mentioned that we do education, we do consulting, and we do data processing. We spend a lot of time with our clients helping them to map out what their business looks like and map that against what the US regulations say should happen. Because gaps between those two create problems and they create risk. And so the way in which these operating models works can be problematic for NQIs. The very first piece to talk about, of course, is documentation. And I say in pretty much every training course and every consultation session that we're in, if you can get the documentation right, everything else becomes much easier and becomes more correct. And that's why it's concerning that the failure rate of documentation, particularly in Asia, is as high as 70%. We'll talk about why that is in a little while. But the primary way in which documentation is obtained by many financial institutions around the world is by using one of the W8 series of forms issued by the IRS. The reason for this is very simple. The W8 series are self-certifications of tax residency signed under a penalty of perjury. As a result, if you have properly received and validated a W8 form, you have no liability if the amount of tax that was withheld is subsequently found to be incorrect because the W8 was fraudulent or falsely completed. Clearly, if you make a mistake, such as you don't validate the form correctly, then you still have the liability. But most financial institutions essentially decide to use one of the W8 forms. So what are the challenges in looking at W8s? First of all, again, we come back to language. The IRS uses very specific language. There is a difference between the term documentary evidence and the term documentation. The term documentary evidence means KYC and AML. The term documentation is KYC, AML, and the W8 form. And many firms do not understand that difference. The second challenge is understanding the fact that if you do use the W-8 form, and that might be, as I said, because you don't want to have any liability for any US tax, the lack of understanding that the W-8 forms have more than one purpose and more than one output needs to come from your receipt of a W-8. That is, from receiving a W-8, you must determine what the Chapter 3 status of your client is, what the Chapter 4 status of your client is, what tax rate to apply to income received by that beneficial owner, and how that tax is categorized either as NRA tax or as a FATCA penalty. All of that comes from one form. And therefore, it's important to make sure that you are able to receive the form on time, validate that the form is correct, and then make sure that the information you need to take from the form and put into your systems is what is needed. I've said a couple of times now, the failure rate of these forms in Europe is about 30%. I would say 30% is unacceptably high, but in Asia, it's between 60 and 90%. And some of these issues can easily be solved. It all starts with understanding how these regulations work. So what are the most common reasons that that failure rate is so high in Asia? Well, the first is called file and forget. There is a financial institution that I will not mention, but when I entered their offices, they had a box on the counter, and on the box, in the box was a pile of blank W-8s. And the W-8s had nothing on them. The sign said, fill the form in, please do not date the form. And the reason was that the financial institution, to make life easy for itself, was taking the form that was undated but signed by the customer, photocopying it, and then date stamping one of the copies. The form is only valid for 3 years. So 3 years down the line, the financial institution goes back to the undated form and date stamps a copy. And so it never needs to go back to the customer to get a new form. It just uses the photocopy that it had at the beginning. And that's not allowed. Okay, that's basically fraud. And it's important to understand that because it's one of the most common things that happens. File and forget is really what lots and lots of firms do, which is they know that they have to ask for a W-8. And so it's typically someone's department, often the onboarding department, that has to get these W-8 forms. But if they don't understand why they're being asked to get the form and what they're supposed to do with it, what happens is that the form is returned. Someone may look at it to make sure that it's the right form, but after that, it just gets put straight into a filing cabinet. So it's file and forget. That's not allowed either. There are rules about how you are meant to validate and make sure that the form is valid. And there are two sides to that validation. The first is called validation on the face. Is the information on the form consistent with all of the other information on the form? And the second, once you've done that test, is to check that the information on the form matches the information in your other records, such as KYC and AML. So if you don't do that check to KYC and AML, you have not validated the form yet. We also find that, again, because the forms are in tax technical American and they're not often in local language, there is a very big lack of understanding about how to fill the form in. And so many firms allow relationship managers to fill the forms in on behalf of the client. And sometimes they will have filled the form in by using KYC and AML information and merely handed the client the form and said, sign here. They're doing this because they don't understand how important this document is. They're doing it in the way that they're doing it simply because somebody told them it's a task. And so that's a difficult issue. It's also all leading to the second last point that I want to make on this slide, which is you need to have training and knowledge to make sure you do this properly. Because if you get the documentation wrong, the withholding may be wrong, the depositing may be wrong, and it's almost certain that the reporting will be wrong. So get it right at the beginning. And finally on this slide, if you're going to do that and you are going to have ways of doing things, make sure you write it down. Many firms do not have policies or procedures that create a framework in which people understand what the purpose of the document is, what's going to happen to it after it leaves them, and how important what they do in validating that document is like. So I'm not going to go through this slide in detail, but when we talk to clients and we map their operating model against the regulations, we often do diagrams. And this is the kind of diagram that we use with clients to help them understand how you would validate a W-8. You would start at the top left and look for key things that clients get wrong and check that they are correct. And on the right-hand side of the diagram, you can see that by applying the rules, you determine what the tax rate is and what the tax categorization is for that client. And what we do by doing this is help the client understand the connection between someone manually validating a W-8 received from a customer and what your banking systems do to process income data when it arrives from your counterparties. Now, that's one way of doing it, but we never stop at one way. We also have another way of doing things. This way is all about, it's called a heat map. And so you'll see there are some red circles on this W-8 and some English text on the left, which is explaining why there is a potential problem with a particular part of the form. Now, this form is a W-8 Ben. And you can see that when someone receives this form, there are certain things that they should look for really quickly, because these are the most common reasons that a W-8 will be wrong. At the top left of the form, is it the right form? This revision is Rev July 2017, so it's the correct form. Is the name of the beneficial owner in Part 1 an individual? If you see the phrase PLC, LTD, partnership, trust, you have a good indication that it's the wrong form. And so on. You can go through the form and identify the important areas to check. And again, we allow our clients to choose which method they want to use in order to validate the forms, but they have to validate the forms correctly. This is the form for the W-8 Ben-E. Now, the Ben-E is for corporations in general. It's more complicated than the W-8 Ben. And many brokerage firms, for example, in Taiwan and Singapore, are dealing predominantly with individuals. And so it's important, again, when you're looking at your NQI status, is to understand what kinds of customer you have. The regulations are designed to apply to every single possible permutation. your business doesn't have every single possible permutation. So it's important to analyze your business and see how it marries up to the regulations, because many parts of the regulations may not even apply to you, depending on what kind of business you have. And so the BEN-E, again, there are certain areas of the BEN-E that are important to get right. And if you do not check them, then you have not conducted due diligence correctly as the regulations require you to do. I mentioned that the system needs to create an output. And so it doesn't matter whether you are manually validating a W8 and then manually entering information into a system, or whether you have some mechanism for automating that process. We've designed digital W8 forms with electronic signatures that financial institutions can use to take data directly without human intervention and put them straight into a core banking system. So there is no paper. But many firms in Asia are still using paper, and we estimate that the number of W8 forms that are out there at the moment in the world is around 900 million. That's a lot of paper. But when you validate a form, because it has several purposes, you should be recording certain information. This is still as a non-qualified intermediary. So this is for a W8 IMY. When did you receive it? When did you validate it? Who validated it? Was it reliable? And here you'll notice that the form can be reliable for different purposes. What's the Chapter 4 and the Chapter 3 status of this customer? Are they US or non-US? Are they an intermediary? Are they a trust, or are they a partnership? Are they a QI or an NQI in Chapter 3? Are they a participating FFI or a non-participating FFI in Chapter 4? So you see the difference in the language that's being used, and all of this information comes from the W8 and needs to be put into some kind of system to make sure that the withholding is correct and that the operating model is correct. Is the form valid indefinitely? Now, a W8 IMY is valid indefinitely or until there is a change in circumstance. So the options have to be transferred from what was written on the form to some way in which that information can be used by banking systems. So in this section, I just want to talk about withholding and reporting, because once you've got the documentation, you are going to be looking at how much tax gets withheld on US sourced income and how do I report it, because those are your obligations as a non-qualified intermediary. So remember, there are two types of non-qualified intermediary: disclosing and non-disclosing. A disclosing NQI will need to present to a counterparty a W8 IMY. That's how the NQI documents itself as a customer to its counterparty. It will also pass all of the W8s that it received from its clients upstream to its counterparty. It will also provide a withholding statement, typically a spreadsheet, that allocates the tax rates for every item of income that is received by those clients. And there are 2 or 3 different ways that that can happen. But that's what happens with a disclosing NQI. A non-disclosing NQI still has to present a W8 IMY to its counterparty. But the boxes that it ticks on its W8 IMY will be different to the boxes that are ticked by the disclosing NQI. So the certification, the W8 form, is saying different things. It's differentiating a disclosing NQI from a non-disclosing NQI. Importantly, a non-disclosing NQI will not pass any of its customers' W8s to its counterparty. So there is no data protection problem, and there is no competitive concern. A non-disclosing NQI does have to send a withholding statement, but that withholding statement is much simpler and merely has to confirm to the counterparty that there is no Chapter 4 penalty to be applied to any of its customers. Clearly, if there is a FATCA penalty to be applied to any customer, then there needs to be a line on that withholding statement to identify that, so that the receiving financial institution can decide what to do and how to categorize its customer. So what I'm going to do now is show you a typical model and show you some of the pluses and the minuses associated with being an NQI or being a QI. Now, this is a disclosing non-qualified intermediary. And so let's work from the top down. First of all, the non-qualified intermediary is trading in US securities, which means that there is a US issuer, and that's typically a US corporation or the US government if it's bonds. And they are making payments, might be dividends or interest payments, and they distribute those interest payments to a US-based withholding agent, who then will pay typically a non-US financial institution, often a qualified intermediary. The qualified intermediary then makes a payment to its customer, the non-qualified intermediary, and for the purpose of this diagram, that's you. Now, you are a non-qualified intermediary, and you have said to your QI counterparty that you are going to disclose. So that means that you will need to gather W8 forms and KYC and AML from your customers. And your customers are going to be one of 4 different kinds. They're either going to be individuals, entities, corporations. They're going to be financial institutions, and they could be QIs or NQIs, or they could be what are called flow-through entities, and those are partnerships and trusts. Now, you may not have all of those client types. You may only have individuals, or you may not have any partnerships or trusts. This diagram is designed to try and help you understand how everything works. And as I said before, we will typically work with you to narrow this diagram down so that it applies specifically to your circumstances. So now you're a non-qualified intermediary. You're going to present a W8 IMY to your QI and all of the W8s for your customers, and a withholding statement that allocates any payments made to those W8s. The QI receives that information and now has everything it needs to be able, when a payment is received from a US withholding agent, to apply whatever tax rate is applicable to your customers, because it looks at the withholding statement to do that. So you are able to access potential treaty rate benefits if they exist in your jurisdiction, and you can then pay your customers in the same way. Now, at the end of the, as that goes through, the person or the entity that's actually withholding the tax is the QI. It's not you. So the QI is sending the tax to the US Treasury. At the end of the year, the QI now has the obligation to provide a 1042-S information report file to the IRS. In that file, it will list every single beneficial owner customer of the NQI in its 1042S report. It will create copies of those reports and send them either to you or directly to your customers, depending on what you choose to do. That's the basic model. So what could possibly go wrong? Well, first of all, remember that counterparties don't like disclosing NQIs because they're going to be receiving all of that documentation and all of that data, and they're going to have to do work. And many will start to charge you for doing that work because they're now going to have to produce reports, they're going to have to validate forms, and they'll want you to pay for that. The good news is that because you disclose to them, if your customer can benefit from a tax treaty, then they may well be given that tax treaty by the QI. Now, I would make a point here about Taiwan in particular, because Taiwan doesn't have a tax treaty with the United States. Now, for a financial institution in Taiwan, you might think that means there is no double tax treaty benefit, but that's not necessarily true. Remember that although the majority of your clients may be Taiwanese, and therefore no tax treaty would apply, you may have customers that have different tax residencies. And so typically in Taiwan, that might be a Chinese tax resident. It may be any one of a number, for example, Philippines. And so if your customer presents you with a W-8 and they're claiming a tax treaty benefit for a jurisdiction that's not Taiwan, then a tax treaty benefit can apply. Okay, so it's not just based on where the financial institution is, it's what the tax residency of the beneficial owner is. The fact is that in most cases, a Taiwan financial institution is going to have at least 90% of its customers as being Taiwan residents. Okay, so the effect may be fairly small, but it's important to understand. The downside, the bad news, of course, is remember that in Asia, over 70% of these W-8s are not fit for purpose. And so the tax rate may be 30%. The question is whether it's being properly reported as a 30% FATCA penalty or a 30% NRA tax. Importantly, because you're an NQI, the reporting is done at recipient level. That means that there could be data privacy concerns. You are going to be responsible for sending the name and address, the tax identification number, and income details of your customers, whether they're Taiwan residents, Singaporean, or Hong Kong, directly to the United States. You may be reporting that as a disclosing, you may be sending that information to your QI, so you're not directly sending that information to the IRS, but the important thing to recognize is because you're an NQI, your counterparty will be sending the reports up. They are the ones that are going to be doing all of that reporting, not you. Equally, as I've mentioned, they are also going to be providing you with recipient PDFs. So that all has to be managed so that it happens within 30 days. So that was one kind of NQI, the disclosing kind. More common are non-disclosing NQIs. And you can see this diagram looks pretty much the same. There are one or two differences. From the bottom up, you're an NQI and you're gathering W-8s from your clients as well as KYC and AML. You are providing only a W-8 IMY to your QI counterparty and a Chapter 4 withholding statement. That's it, you're done. That's the good news. It's less work. The bad news is that when a payment is made by a US issuer down to the QI has no choice. It cannot grant any tax treaty benefits because it doesn't know who your customers are and whether they're eligible for a tax treaty rate. And so it makes the payment net of 30% on all occasions. So there's the first point. What happens is that the QI still pays the tax to the US Treasury, but at the end of the year, instead of being able to do the reporting for the NQI's customers, it doesn't know who they are anymore, it's going to produce a 1042-S, send it to the IRS, and that information report is going to say, we paid this NQI a certain amount of money, and we withheld 30%, and we do not know who the final recipients were. And that's where you can see the line between the QI and the NQI showing unknown recipients. That now means that the NQI has the obligation to produce 1042-S per recipient and send it to the IRS and send a copy to the customers. So it's a slightly different model. There is good news in as much as there's less to do with the counterparty because you're not disclosing, but you're not getting treaty benefits and you have to do the reporting. Let's summarize that. We start, of course, with the fact that lots of those W8s are going to be unreliable. If you're in a jurisdiction like Taiwan, that might not seem as important as usual, or for example, with Singapore and Hong Kong, but the fact is the W8s must be correct because they're not just looking at the tax rate. They're also looking at FATCA classifications and Chapter 3 classifications that you must do anyway under the regulations. Second is, as I said, you get no access to reduced tax treaty rates. The Chapter 4 withholding statement must go between the NQI and the QI. This is very, very badly understood by NQIs. And that's because the IRS put this requirement into a tiny little piece of the regulations. And there's a rule sitting in there that says, if the NQI in Chapter 3 does not provide a Chapter 4 withholding statement, then this QI will immediately say, this is now a non-participating FFI in Chapter 4, and it doesn't matter what you said on your W8 IMY. So there is a consequence to not understanding what a Chapter 4 withholding statement is. As I've said, as a non-qualified intermediary, if you don't disclose, it's your job to report to the IRS. That means that you directly have a potential data privacy issue because you are going to be sending the name and address and tax ID and other information about your non-US customers, so Singaporean, Hong Kong, Taiwanese residents, their information is going straight to the US government. You'll notice that in these models, every financial institution in the chain of payment has a report that it sends to the IRS. These reports are called cascade reports, and they must match. So when the IRS gets a report from the QI that says, here's how much we paid the NQI, and then the NQI sends a report to the IRS and says, this is how much we received, those two numbers should be the same or within very, very tight limits. If they're not, you, as the lower financial institution in the payment chain, will get a penalty notice. That might be for inaccurate reporting. It may be for assessment of unpaid tax. And if you report late, of course, you'll get late filing penalties as well. All this can look very complicated, and it's more complicated because you're an NQI. Finally, we're going to look at what happens when you become a QI. Now, as a QI, there are a number of things that happen. The first, as I said right back at the beginning, is that the IRS trusts you more than a non-qualified intermediary, and so they give you some benefits. So again, you are still now required to get W-8 forms from your clients, but now when you send a W-8 IMY upstream to your counterparty, you'll be telling them we're a qualified intermediary. You don't need to identify each client. You can give them what's called a pooled withholding statement. That might say, we have clients that are entitled to a 15% tax rate, and here is the proportion of the payment that is at that rate. And that's fine. And so you have not disclosed any of your customers to your counterparty. However, you will have been able to tell them in a pooled way, an aggregated way, whether any of your clients are entitled to a treaty rate. And so when a payment is received from your counterparty, you can receive it at a reduced rate. So you get the benefit of being able to grant tax benefits. The tax can still be paid by your upstream counterparty, or it can be paid by you if you want to. When your upstream counterparty sends a report to the IRS, they will merely say, our customer is a QI, and here is how much we paid them. You get that, and now you have to produce reports to the IRS. But unlike being an NQI, you can pool those reports, so all of the 1042Ss that would have been produced for everybody taxed at 30% would all go into one form. So the number of forms reduces drastically. The other benefit that QIs get is that you only need to provide a recipient with a copy if they gave you a W-8 IMY. In other words, direct clients who are individuals and entities, you're not required to produce a 1042S for them. So the effort involved is much less for a QI. Let's take a look at what that looks like. So the good news, no disclosure to a potential competitor. No disclosure to the IRS. So you get to keep the names of your clients secret. You get to be able to give reduced tax rates if they apply and if they're claimed by your clients. You don't have to produce 1042Ss in all cases for your customers. So being a QI clearly has some operational benefits, and the workload associated with being a QI is often a lot less. But I just want to make the point about the cost and the risk difference between being an NQI and a QI. And the reason for this is that many NQIs miss the reporting deadline and they file late. And there is a penalty that's applied by the IRS based on how late the forms are and how many forms there are. So here is an example of the difference. If you were an NQI and you had 500 customers and they received dividends and interest in 2019 via an upstream counterparty and a US withholding agent, then the likelihood is that as a non-qualified intermediary, because you have to disclose every person, you would have been providing 4,000 1042S forms to the IRS, and because you're a non-qualified intermediary, you'd be providing 4,000 recipient copies to your customers. If you file late, the potential penalty would be $800,000. On the other hand, if you are a qualified intermediary, because you are aggregating all of your clients simply based on the tax rate that was applied to them, excuse me, the number of forms that you would be sending to the IRS would only be 12. If all of your clients were direct clients, then you wouldn't be producing recipient copies at all. And so a QI that reports late on the same basis would only face a penalty of $1,200. That is an enormous difference. And that's what reflects how little the IRS trusts NQIs. So let's look at the penalties. And these penalties start with whether you're filing late to the IRS. So if you fail to file by the deadline, the penalty is $270 for every single form. If you manage to correct that within 30 days, then the IRS is good and they will allow you to pay a $50 per form penalty. If you leave it longer and but you still manage to file before August 1st, then the penalty goes back up to $100 a form. And finally, if it's after August the 1st and you still have not filed, when you eventually do file, the penalty goes back up to $270 a form. Across that, the IRS places caps. So the cap is a maximum of $3.2 million. But remember, you also have to file copies with your recipients. And there are penalties if you do that late as well. They're the same as not filing correctly to the IRS. And as I said earlier, if you fail to file to the IRS on time, it's almost certain that you will have failed to file to your recipients. And so the actual penalties that you are looking at are a cap of $6.4 million in your penalties, depending on when you file your forms. If you file after August the 1st, and some firms file very, very late indeed, the IRS can impose another kind of penalty, which is called intentional disregard. Intentional disregard is $540 for every form, and there is no cap. So you can see, if you are a non-qualified intermediary, you have to get this right, because the penalties can get very large very quickly. So we've looked at the challenges for being a non-qualified intermediary. Documentation is common. The withholding model, do you disclose, do you not disclose? Many firms make decisions without understanding why they're making the decisions. And we spend lots of time with clients helping them to understand what it means to be a QI and what the benefits are. The first is whether you're even eligible to be a qualified intermediary. So here is a list of countries in Asia and whether or not they have a double tax treaty, whether they have a FATCA IGA, and also whether the IRS has approved their local Know Your Customer rules. So in order to be able to be a QI, you must be resident as a financial institution in a KYC approved jurisdiction. So if you look at the first column, financial institutions in Malaysia, China, and Philippines cannot be qualified intermediaries because their KYC rules are not approved. All of the others can. You must be in an IGA jurisdiction, in other words, a jurisdiction in FATCA where the IRS has signed an intergovernmental agreement, or if there's no intergovernmental agreement, then the financial institution has directly signed an FFI agreement. And you can see that all of these countries have one or other types of IGA apart from Korea. So in order to be a QI in Korea, the KYC rules are approved, but a financial institution would need to have signed an FFI agreement. Now, the final and middle column on this slide talks about double tax treaties. There's no requirement to have a double tax treaty in order to be a QI, but non-qualified intermediaries should consider the implications, because giving tax treaty benefits is one of the big benefits involved. It's not the only benefit, and certainly data privacy is a major issue as well. So when we are coming to make discussions with clients, we often create a diagram to help them understand what kind of things they need to be thinking about if they're thinking about becoming a QI. The first is, can you afford not to offer trading in US securities? Well, a lot of financial institutions in Asia do a lot of trading intra-region, so between member states in the Asian region and in ASEAN. Now, the problem is that it's very rare for a financial institution not to offer US trading. And there's a very simple reason. If you look at the market capitalization of all the corporations in the whole world, 53% of the market capitalization of all the firms in the world is in America. And so it's very difficult for a financial institution, even one that's a domestic institution, not to want to offer US trading, because it's an attractive thing that people would like to do. So usually the answer to that question is, no, we can't avoid trading in US securities. If you can, then fine, stop offering US trading, but you will still be affected by FATCA. If you do want to offer trading in US securities, do you have a very large number of clients? Now, this will affect brokerage firms that have a very large retail client base, as opposed to brokerage firms, for example, or custodians, which have a mix of individuals and entities, or perhaps even other financial institutions. And so you need to look at what kind of clients you have. If the number of clients you have is not really very substantial, then typically you might say, well, why don't we just become a non-disclosing NQI? We'll be taxed at 30%. There's a risk of FATCA, and we'll have to do the beneficial owner reporting, but the number of clients isn't very large. So that's the kind of thinking that we go through with our clients. If the number of clients is very substantial, the question then becomes, are you prepared to disclose your clients to another financial institution? Well, if the answer to that is yes, then you would become a disclosing NQI. You might get some tax treaty benefits if any of your clients are entitled to them, and your upstream counterparty would have to do all of the reporting for you. That sounds great. The problem is whether your upstream counterparty will allow you to do that. And even if they do allow you to do that, they will very likely charge you a big fee for doing so. And that's before you even think about, well, if I give them my list of customers, they might try and take those customers away from me. So most financial institutions decide, no, they don't want to disclose their clients to another institution, and often they would prefer not to send that information to the US government. The final question then becomes, okay, so you want to offer US trading, you have a substantial number of clients, you don't want to disclose those clients to a competitor, and you prefer not to disclose them to the US government. Is your reputation important to you? Or perhaps you're being told you must be a QI. If either of those questions is answered yes, then really your decision is that you should make yourself into a qualified intermediary. You will be able to pool your reports so there's no disclosure to anyone else. You will be able to pool your report and your withholding so it makes life operationally simpler. The only downside is that you will need to have some level of oversight from the US government as to whether you're meeting the terms of your QI agreement. And that's what I'm going to talk about next. When we first started this presentation, I showed you that a non-qualified intermediary had 4 obligations: documentation, withholding, depositing, and reporting. If you become a qualified intermediary, the same 4 obligations exist, but those obligations are lower because you get benefits from being a qualified intermediary. In withholding, you can offer tax treaty rates. In reporting, you can pool your reports and not disclose your customers. There are 3 things that you need to do that a non-qualified intermediary does not have to do. The first is, of course, you have to sign a QI contract with the IRS. That means that you would be subject not just to the regulations, but also to a commercial contract. And by the way, you don't get to negotiate the contract. The contract is the contract. You will either sign it or you don't. You don't get to change the terms or even negotiate them. In addition, there are 2 aspects where the IRS wants to make sure that if you sign a contract with them, that you will meet the terms of that contract, and that's control and oversight. So becoming a QI means a lot of operational problems become much easier and you get benefits, but there is an additional level of control that you need to put in place to be a QI. So what does changing to QI status mean? First of all, you would decide to sign the contract. The application form is online. The contract itself is in Revenue Procedure 2017-15 and is at least 120 pages long. And the contract is for 6 years. So the application is relatively easy. You do have to prepare some documentation and some information, and then take that online to the IRS and complete the forms. But I do say this word of caution. I speak to many non-qualified intermediaries who say, oh, it's easy to be a QI, we just apply online. Well, that's true, but incomplete. It is easy to apply online if you know what you're doing. The big piece is whether you are able to comply with that commercial contract for 6 years. That is not as easy unless you have help. So when you become a qualified intermediary, you do get to simplify your operating model. You don't disclose direct clients, so you don't have a data privacy issue. And that data privacy issue might not just be with your regulator, that might be with your customer who realizes all of a sudden that his name or her name is on a report that's been sent to the IRS. And so we do see many financial institutions where the clients, when they find out that they're dealing, their account is with a non-qualified intermediary, will look at changing their account to a qualified intermediary. In other words, they'll move their account because they know that if they have an account with a qualified intermediary, their information won't be shared with anybody else. And so in any given market, whether it's Taiwan, Hong Kong, or Singapore, clients start to become smart and they start to realize that it's better to have an account with a QI than it is with an NQI. And so many firms start to use their QI status as a competitive edge. It's better to have an account with us because we're a QI. You don't want to have an account with a non-qualified intermediary because they're going to tell everybody who you are. So there is a competition issue here. You also get to simplify your withholding. Usually that's done because all you will need is a small number of omnibus accounts and into which you place the assets of your customers based on what the documentation said their tax rate should be. Your counterparty then merely taxes the income to those omnibus accounts based on what the assets are. They never find out who owns the assets. The other operating model simplification is that your reporting is pooled, so the number of reports is lower. You're not exposing your customer data, and the penalty exposure is much lower because any penalty that is calculated for late filing certainly is calculated on the number of forms. Now, I mentioned control and oversight. When you sign the QI agreement, you do sign to say that you will appoint somebody in your company to be a responsible officer. That's got to be somebody senior whose job is to make sure that your firm meets the obligations of the QI contract. One of those obligations is you must have a written compliance program. So you must have a document that says, here is what we do, here is how we do it, here is our QI contract, and here is how we meet the obligation of being a qualified intermediary. That's the cost of being able to be a trusted partner of the United States government and a qualified intermediary. The regulations and the QI agreement also say that you have to have effective systems, you need to have training and enough knowledge to be able to implement that contract. Well, that's normal. Okay, so there's a control mechanism in place, and we help clients to create compliance programs. We've created compliance programs for many firms. And so our obligation to you, if you use us as a provider, is we have a template for what a compliance program looks like. We know what the decisions are, we know what the policies should be, and we know what the procedures should be. All we have to do is map what your business looks like to what the IRS expects you to do as a qualified intermediary. I also mentioned oversight. Now, the IRS doesn't just sign a contract and leave you to it. The IRS allows you to have the contract, but then it says, we need you to bring someone independent in every 3 years to check that you are doing the right thing. And so they define something called a periodic review. Now, if you are a small qualified intermediary, so if the amount of US sourced income that you receive is not very much, you may be able to ask the IRS for a waiver of the periodic review, because bringing an independent expert in can cost a lot of money. And so small QIs will often apply for a waiver of the periodic review, which makes life a lot easier. Every 3 years, the person that you appointed as a responsible officer has to go to the IRS website and make a certification that in the preceding 3 years, your firm met the obligations of the QI agreement. If you did not, then your responsible officer must tell the IRS what the failures were and say how they're going to be fixed. So there is a system in which that kind of failure can be corrected. The IRS today is working with 12 QIs who have gone to them and said, look, we're having a problem. We need your help. Can you give us some guidance on how to best comply? Okay. So the IRS is very happy and they want to help QIs to do a good job. So, concluding this webinar, non-qualified intermediaries do face reputation, operational, and financial risks. you can choose to accept those problems and those risks. No one is trying to force you to be a QI, unless, of course, another financial institution won't do business with you unless you're a QI. If you're going to convert to being a QI, I am strongly of the opinion that you should make an informed decision. That means creating what we would call an exposure map that looks at what your business is, where it's located, what kind of clients you have, how many upstream counterparties you have, what kind of accounts you have with them, creating that model, understanding what the options are in terms of being a qualified intermediary. There are more than one kind of QI. So create the exposure map to understand what it is that's going to change in your business in order that you gain the benefits of being a qualified intermediary. And that leads you to, you need a reasonable understanding of just what you're getting into. There are lots of QIs that do a great job. Many QIs who struggle and need help. And so my final point is that having the right subject matter experts who can give you practical guidance, especially in Asia, and there are very, very few subject matter experts in Asia. I can probably count them on one hand. Most of the subject matter experts on this are outside of Asia. We, as I've said at the beginning of this, have local representation in Taiwan at the moment and Hong Kong, and we're able to deal with clients on a global basis. We can converse in Chinese and in English, and we have a number of other languages that we support. But the important thing is not the language here. The important thing is making sure that if you're going to make a decision and become a QI, that you have somebody who knows how it works and who can tell you how it works in easy to understand ways. I just want to take this last piece to thank Amanda for helping to organize this, to Amanda and Marco for reaching out to all of the financial institutions who are watching this webinar today. Contact details are on the screen now, but you are more than welcome, if you want to email me directly as the chairman of the company. We would love to be able to help any of you to understand your situation, either as an NQI or to help you become a QI, or if you are a QI, to help you comply more cost effectively and more simply. So thank you very much for your time today. It's been an absolute pleasure. And I'll now hand back to Amanda just to say thank you very much from our local office.
Thank you, Ross. That was a very informative presentation.谢谢 Ross 带来这场非常精彩的演讲。那相信各位嘉宾听完之后更了解成为 QI 的好处。那会后我们会与各位嘉宾联络，询问是否需要今日的简报。那当然我们也很乐意协助您依循美国税法从 NQI 成为 QI。那我们接着将时间交给 Kirsty。Now I'll hand over to my colleague Kirsty.
Thank you to Ross and Amanda. If you have any follow-up questions about any of the points mentioned in this webinar, please email them to Ross. You can see his email address on the screen at the moment. If you have a question that you wish to phrase in Chinese, please do email it to Amanda so she can translate for us. If you have any feedback about today's training course, please complete our feedback survey. You'll be directed to the feedback survey when you leave the webinar. We hope you found this webinar useful, and look forward to receiving your feedback. Thank you for joining us for today's T-Consult webinar.